think we're going to get started. Good afternoon. My name is Barnaby Levin. I'm on the board of directors at SIEPR, and I'm a managing director and partner at HighTower Advisors, who is honored to be sponsoring two of our panelists, Marty Eichenbaum and Sergio Rebelo. And I'm very excited to be moderating this panel today about currencies. I think I have a little bit of a more pessimistic outlook than a lot of people do, even though we've talked about it throughout the day. But one of the things that I think, given the deficits that we're building globally, I think currencies are going to be impacted by this. And so the hope today is to not only offer some insights into some global macroeconomic trends and the role that currencies can and do play from three top authorities, but also to offer some actionable ideas that the audience can take and put to use in their own portfolios or their clients' portfolios for long after the summit's over. So each speaker is going to be about 12 and a half minutes. Marty and Sergio are going to be collaborating as part of their presentation. And with the panel's permission, I'm going to keep the introductions very, very short. There's information in your packets about their background. Sergio Rebelo is the Tokai Bank Professor of International Finance at the Kellogg School of Management, where he has served as chair of the finance department. He has been a consultant to the World Bank, the IMF, the Federal Reserve, and the ECB, and has studied the causes of business cycles, the impact of economic policy on growth, and more recently, devaluations and the return to currency speculation strategies. Marty Eichenbaum is the Ethel and John Lindgren Professor of Economics at Northwestern University and is co-director of the Center for International Economics and Development. He's been a senior advisor to the Federal Reserve Bank of Chicago for the past 12 years, as well as the Federal Reserve Bank of Atlanta, and is on the editorial boards of the American Economic Journal and the Journal of Macroeconomics. His recent articles have focused on the causes and consequences of currency crises, the effect of exchange rate fluctuations in developed countries, and the effects of changes in monetary and fiscal policy. Kieran Osborne is the Director of Research at Merk Investments, considered one of the leading authorities on currencies, and is co-portfolio manager of two of the firm's funds. Kieran is a certified financial analyst, holds a Master of Business from the University of Otago in New Zealand, as well as a Bachelor of Commerce and Tourism. And in addition to currencies, his expertise is in the areas of macro trends and quantitative financial modeling. So now I'd like to turn things over to Marty for some initial thoughts regarding his and Sergio's economic outlook.
Right. Thank you very much. It's always a pleasure to be here, especially when the weather is this nice. I can't promise anything as sweeping as the history of mankind and the deterioration or improvement of institutions, but I do want to give a brief background, really to set the stage for Sergio's talk, which is more geared at actionable strategies. And that is our own particular view on the economic outlook. In a nutshell, we remain convinced that the basic prognosis of the Fed is correct, which is we are on an unprecedentedly modest recovery given the size of this recession. And what might surprise you, very little inflationary pressure. So just in terms of forecasts, these forecasts that are up behind me, fortunately it's a little hard to see, you can see real GDP growth, 2.3%, 2.7%. Those very slow, very, very slow. It's consistent with what happens after financial recovery, after financial crises, but relative to other recessions in the United States, which were not associated with financial crises, at least not since the Great Depression, remarkably shallow recovery. Inflation, very muted. That 2% is kind of consistent with the Fed's target, but it's certainly inconsistent with some of the rhetoric that you might hear out there. I'll come back to that in a moment. Finally, unemployment is coming down slowly. Basically President Obama is going to be running on a roughly 8.2% unemployment rate. But the unemployment rate really understates how bad labor markets are. If you look at employment rates, those are unprecedentedly low. So this is not a booming economy, but nor is it a crisis economy. It is certainly not a crisis economy. I want to turn to the issue of inflation briefly because that has some impact on thinking about exchange rates, obviously. What Sergio and I have graphed here is you can back out of Treasury inflation-protected securities by comparing those rates and nominal interest rates and making various corrections for liquidity effects, et cetera, and inflation risk premia. What does the market think inflation is going to be? And so what we've got graphed here is what does the market think the inflation rate is going to be, the one-year rate of inflation 1 year from now? What does it think the one-year rate of inflation is going to be 2 years from now, 3 years from now? What should strike you from this graph is the market thinks it's going to be under 2% indefinitely. There is simply no evidence, market-based, that anybody in the market thinks inflation is going to be tremendously large. Remember, 2% is the Fed's rate. Now, there's certainly critics out there who say it's the end of the world, the Fed is going to destroy the universe as we know it. Those critics tend to think bond markets are pretty rational. Those critics tend to think markets are pretty reasonable. You can't say two things at once. The markets work pretty rationally, and the end of the world is coming as far as inflation is going. Those things simply are inconsistent with the data coming out of the market. This I want to emphasize are market, backing out market-based expectations. You might say, well, look, it's treasuries. The Fed is, of course, playing a very large role in there. So you could go to corporate bonds and ask, does the market there show you enormous expectations of inflation? It's not there. Now, two responses. The market's wrong. That's entirely possible. But that's at least the market-based expectations. Now, you might say, how could this possibly be? We know all about the monetary base has gone completely crazy, and doesn't that always and everywhere mean inflation? We are actually at Hoover, or close to it in spirit, and so Milton Friedman's ghost is hovering somewhere above me. It matters exactly why the base went up, right? And I can make a separate argument if we had more time why you ought not to be particularly worried about the base coming up in the United States as much as it did. We'd get into some minutiae. But let me do something more powerful. Let me point to some data. This is data from Japan for 15 years. The base went crazy. Inflation did nothing. So whatever else is true, it's a counterexample to the simple-minded view that whenever the base goes up, inflation is going to go crazy. The details matter. We can come back to this if anybody's interested. But that's not a theory. That's just the facts from Japan. Now, so what we think is that we're in reasonably good shape going forward, but there are certainly downside risks. As you all know, it now looks like this morning there will be an orderly restructuring of Greek debt, accompanied by roughly $130 billion of rescue funds. I do think an important concern that hasn't gotten enough attention is exactly how this will impact on the usefulness of CDs for hedging sovereign credit risk. I haven't read the paper in the last couple hours, so I don't know if we're going to have a CDS event or not. But if we don't, right, basically what we will call an involuntary event, we're going to classify it as voluntary, which means why would you pay as much for CDSs? So we don't know how the market going forward is going to treat CDSs. The ECB, how did it deal with this problem? Well, basically, it's bought Europe time to get its house in order by providing banks with 3-year loans at 1% rates. And basically, the banks use those loans to buy sovereign debt, right? And so I'll show you in a moment, yields on sovereign debts have certainly fallen, right, as the banks have basically used that cheap money to buy higher yielding sovereign debt. And they're also using those profits to recapitalize themselves without tapping equity markets. So those are all good things in the sense that that was the purpose of the policy, and that's what they've done. What's the minus? Well, the European banking system has just placed a massive bet that the European sovereign debt crisis is going to work out. So if it works out, that's great, and if it doesn't, they're all going down, and there are no more European banks. Right? So they've basically levered up that bet, in our view. So our personal prognosis, based on our own reading of the situation and policymakers that we know, is there'll be slow growth, but no meltdown. Right? There's no obvious reason to think there'll be a meltdown at this point. And we do think an important contributing factor to the slow growth in Europe is what we view as very counterproductive, contractionary short-run fiscal policy. This is obviously debatable, but based on our own work, we think that it is deeply counterproductive in the short run. This is just a graph of the yields, and it's really a tale of two cities. You can see that clearly the effects of what Mario Draghi has done. They intervened in these markets, and exactly at that peak, that's when these rates start coming down. So this has clearly worked. Now, the problem is Greece and Portugal are so off the map that I didn't put them on this figure because I'd skew the whole thing, right? So the question is, Greece is now settled. Markets are now presumably turning to Portugal. Sergio can't say certain things about Portugal because he's very involved with various advisors there. But if I was a Portuguese citizen, I'd say, how come only the Greeks get a write-down? So we'll see what happens there. Downside risk, just looking forward before I turn things off to Sergio. Another obvious important downside risk are oil markets. There's just enormous instability in the Middle East. Oil prices have already risen by 15% since October, in part because of the recovery, that's the good news, but in part because of rising political risk. So if you ask me where I say, if something happens with Iran, and many things could happen, notice what I say, if a war with Iran breaks out, there are many possible scenarios where that could happen. Our own view is all bets are off, and that's a very serious possibility. Exactly how serious, nobody knows. My Israeli friends tell me, if somebody says something to you, they don't know what they're talking about, because if they knew what they were talking about, they wouldn't tell you anything. So I'll just stop with that.
All right, so let me switch gears a little bit and talk about some asset pricing anomalies. And what I want to show you is strategies that have really stood the test of time, and that form the core of a lot of what hedge funds do. So many people think hedge funds use complicated methods, neural networks, Russian mathematicians and so forth. But a lot of what they do is actually quite similar, and they take a lot of their ideas off the anomalies that I'm going to show you. Of course, anomalies is a name that academics use if you're trading in ways of making money. So 1 minute price theory slide. It shows you the formula for the capital asset pricing model, and on the left side of the equation you see the excess return. So that's the return you would earn in excess of the risk-free rate. How much more return would you get over the risk-free rate? And then on the right-hand side there's alpha, which should be zero. There should be no alpha. And all the return that you're earning above the risk-free rate should be a compensation for risk. And so what is risk? You have beta, which is the covariance between, a measure of covariance between the asset that you're holding and what you already have in your portfolio. And then you have the difference between the market return and risk-free rate. So that's the standard formula. So I'm going to show you that all these strategies generate alpha that's positive, and that's why they are anomalies, so that alpha should be zero. And in particular, the currency strategies I'm going to show you have a beta of zero, so they don't correlate with anything. And so if you have a strategy that's uncorrelated with anything inside, it should earn excess return of zero. So let me go to that. So these are the anomalies that I'm going to quickly show you. Value size, stock momentum, carry trade, and then currency momentum. And I'm going to show you a little bit the Sharpe ratio, how much return you get per unit of volatility, and also how the beta and the return are related. So here's the first so-called anomaly. It's the value anomaly, and it's a very old anomaly. So Benjamin Graham wrote a book in the 1920s called The Intelligent Investor. He made a lot of money during the Great Depression using this value strategy, and he had a famous student called Warren Buffett who took his class at night at Columbia. So the idea is just to rank firms according to book to market. You make a list, and then you go long on the top 30% of this list, and then you go short on the bottom 30% of the list, and you ignore the middle. So that's the value anomaly. I'm going to show the results of these anomalies all at the same time. So the next one is size. It's also an old anomaly in finance. Again, this time you rank firms according to size. You go short the top half, the big firms, and you go long the small firms. The next one is also a strategy that's been used by practitioners for many years. It's called stock momentum. It just rides on the idea that maybe what worked in the past is going to continue to work in the future. And remember, for a long time, people thought that the stock market was exactly a random walk, so this wouldn't work. But then there were some subtle deviations from the random walk that cropped up. So the way this strategy is constructed is, again, we're going to look at stocks that have done relatively well. It's a relative momentum. So things that have done relatively well in the past 12 months or so, and we're going to go long on those, and then we're going to look at ones that have done relatively poorly, and we're going to go short on those. All these strategies are zero net investment strategies. You go long on something, and you go short on something else, and you don't invest any money on net. All right, so these are stock strategies. The strategies that we studied in a lot of detail with one of our co-authors, Greg Burnside, are currency strategies. And the first one is the carry trade, which is the most widely used speculation strategy in currency markets, period. And it's a strategy that's supposed to not work because it's so simple. And it has been around since the Romans. I think during the Roman Empire, probably people were doing the carry trade. So how does it work? Well, you borrow currencies that have low interest rates. Right now, the United States has interest rates that are very, very low. So you borrow dollars, and then you lend New Zealand dollars, which have a high interest rate, or you lend Brazilian real. Right? And if you open up a finance book, sometimes it says, well, there's something called uncovered interest parity that says, on average, this shouldn't really work. Right? So we're going to look a little bit at that. Now, when I show you results for the implementation of this strategy, it's very important when you implement this strategy to have a diversified portfolio of currencies. So I'll show you the results are astonishingly good. We don't really quite understand why. But it's very important to diversify across currencies. If you just have one currency in the portfolio, you have a lot of tail risk. And so sometimes the carry trade is described by traders as picking up pennies in front of a truck. Because if you just trade two currencies, if the pennies you're picking up is the interest rate differential, because exchange rates are roughly random walks. So if you borrow at 1% and then you lend at 7%, you basically get that 6% differential. So those are the pennies you're picking up. But then the truck one day comes and the currency that you are investing depreciates like crazy and you're there dying. So you want to avoid that. What's surprising is when you diversify across currency, in sample, you can't see anything. I mean, all this tail risk completely goes away. But if you don't diversify, this is a bit of a dangerous strategy. And of course, there's Mrs. Watanabe, which is this mythical Japanese housewife, which does the carry trade at home, and between the Japanese yen and the New Zealand dollar or the Australian dollar, and that is quite dangerous. So everything that I'm going to show is for a portfolio of currencies. So the other strategy we're going to look at is currency momentum, and it's very similar to stock momentum. Basically, you're going to look in the past and see what currencies have done well. You had invested in these currencies, and you're going to go long on those, and then you're going to look in the past and see which currencies did poorly, and you're going to go long on those. And none of this stuff should work. You see, it shouldn't really work. Right? Okay, so let's see what you get if you implement this strategy. So this is a chart that shows you on the x-axis the beta. So remember, the beta measures the market risk of these strategies. It measures how the payoffs to these strategies correlate with the U.S. stock market. And what you can see is all the strategies cluster around the beta of 0. They have no correlation on the U.S. stock market. Right? So they should have an excess return of 0. They should not work. All right? But you see, it's a problem for academics that they work. They are all up here. So you can see value.
Momentum one at the top is the stock momentum.
Stock momentum, correct. So that's stock momentum, currency momentum, the carry trade, value and size. So you see they are all above that line that the CAPM predicts they should be on. Now, you don't want to just look at this statistics, so it's important. Let me show you how the strategies have performed over time. So in all these panels, you see the stock market, and then you see the payoffs to the various strategies. And I want to point out a few things here. So the first one is that I'm going to show you in a moment what happens if you put all these strategies together in a basket. And what happens is amazing. It should not be happening, but it's a strategy that has phenomenal properties in sample. So it's important to diversify across currencies when you are doing a currency strategy, and it's also important to diversify across strategies. Right? But it's very hard to do that in practice. It takes tremendous discipline, and you can see here why. So take a look at momentum. This is stock momentum. This is like we hear there's people from hedge funds that have airplanes called momentum. and you can see why, because it was the gift that kept on giving, right? Look at how this outperformed the stock market. And remember, it has a beta of 0. It's not correlated with the stock market. It's just an amazing strategy. But what happened in 2009? A negative return of about 80%. So if you had all of your eggs in that strategy, as some hedge funds did, this was not a good year for you, right? So this strategy in and of themselves, you can see they have some tail risk. And we always worry, even if you didn't see it in sample, maybe it was because we have a lucky sample, and that tail risk will materialize out of sample. Now, the other thing I want to show you is the currency strategies. And you can see the reason these strategies look so good is because they have very little volatility. They basically have the same cumulative return as the stock market, but their volatility is very, very, very low. So that's why they are important anomalies in finance. So this is another way to look at the tail risk. It shows you the worst. It shows you the histogram, the distribution of in-sample returns, and it shows you the worst return that has materialized in sample. And so it's important to be aware that there's some crash risk for all of these strategies. And I briefly mentioned already there's two ways to deal with the crash risk. So one way is to diversify. When you're doing currencies, diversify across currencies. When you're doing currencies and stock strategies, diversify across all of these strategies. We also done a lot of work on trying to approach the problem of dealing with crash risk in another way, which is to just hedge the downside. Because you see, I'm showing the stuff in sample. So when I want to, again, putting back the chart for currencies, remember the carry trade, which is over here. People say, oh, it's picking up pennies in front of a truck. Well, we now have 30 years where the truck never showed up, right? But you cannot guarantee, I think the moment Marty and I start implementing that strategy, maybe the truck will show up, I don't know. You cannot guarantee that the truck will not show up out of sample. Maybe you just have 30 years of a lucky sample. So maybe there's a crash risk out there but never materialized. And this is a fantastic little theory because it's in principle it's completely untestable, right? We are afraid of the truck, it might come, so we don't do it. But because we have options markets, we actually put a barrier so that the truck doesn't come. You can hedge against this truck, and I'm not going to show you the results today, but we've done a fair amount of work on this. And the puzzle there is when you hedge the downside, the returns are still high. So these are clearly anomalies. We don't really quite understand them. And I should say that people have also developed measures of risk that are specific to currency markets, saying, well, maybe a lot of people do the carry trade, so a lot of their portfolio is in the carry trade, so we shouldn't really use the stock market as the reference. So they use currency-specific ways of pricing strategies. But it's interesting that when you develop those for the carry trade, they don't price momentum. They don't price currency momentum. When you develop them for currency momentum, they don't price the carry trade. So to us, that doesn't really make much sense. All right. This chart quickly shows you, again, the benefits of diversification as far as realized returns in sample, looking at the worst that can happen. So you can see that if you just have all of your bags in one of these strategies, let's look at annual returns. You can see that, you can have a really bad year, right? And of course, if you're running some kind of hedge fund, this bad year materializes in more than one way, because not only do you have a very lousy return, but also your clients take off because he says, well, thank you very much. I can, to lose money, I can do it without paying any fees. I can actually do that by myself. Right? So you have a lot of drawdowns on your hedge fund. But you can see the effects of diversification playing big time, which is when you put strategies together, then even the downside. Look, when you put all these strategies together, the worst year that you could have gotten was 2009, and you would have lost 4% in that year. So let me end, and of course we're here to take any questions you might have, but let me end by showing you the comparison of two cumulative return plots. One is, suppose you had taken the dollar, started in 1976, invested it in the stock market, that's the blue line. And then suppose you had taken the dollar and you had invested it in a portfolio of these 6 strategies that are these 6 anomalies. So the 4, the market plus the 3 stock market anomalies, and then the 2 currency anomalies, and you divide them equally. And you can see what's amazing is the cumulative return is very similar, but the volatility is very low. To hang on to the market, you got to take a lot of anti-acid pills and so forth. If you have these strategies, the reason the Sharpe ratio is very big for these strategies is not that the return is much higher than the market, it's because the volatility is very low. All right?
Kieran, thanks.
Have we got the slides?
I'm sure it is, but you may have to. I'm not sure where they are, but once you shut our file.
Maybe the desktop.
Yeah, minimize that one. Did you see your slide?
Do we have a computer tech person here? Do we?
Yeah, up.
While we're waiting, it might just, so it's not dead time, it's really interesting. If you look at the crisis period, to highlight the benefits of diversification, the carry trade lost some money during the crisis, but currency momentum actually made money, which is quite extraordinary. So you can see there actually, the relationship between the payoffs on the carry and the momentum in currency, it's close to 0, which means combining them is a free lunch.
So while we're waiting, I had a question about your market-derived forward-looking inflation slide.
Yeah.
have you ever been able to look at the period in the early 70s, late 60s, before we had the, I guess that 74, 75 inflation? We got prime up to what, 22%? We had the gas.
Pretty high.
Was there any way to do a market, a similar research to see what the market projection for the forward-looking inflation was in 19?
It was difficult because we didn't have widespread sales of tips, right? So you didn't have anything as clean as we have now. But there were surveys, and one of the things that we find is that the surveys did lag a little bit behind actual inflation, but you don't have the clean experiment that we have right now. I don't want to take his time. Why don't we come back? I'm happy to come back. That I'm looking forward to, but I don't want to steal your time.
Great. Okay. Yeah. Sorry about that. Yeah. So as Barnaby pointed out, I'm Kieran Osborne. I'm the Director of Research at Merk Investments. We focus squarely on the currency space, and in fact, we blend quantitative approaches to investing as well as qualitative approaches. So we do use proprietary variations of some of the strategies that Sergio just talked about. But what I'll talk about here is we believe also that macro approaches to investing, more qualitative approaches to investing, can be profitable within the currency sphere. Specifically, we spend a lot of time analysing different monetary policies around the world and believe that they can have significant influence on the valuation of various currencies. So this first chart here, you can see the line that sticks out quite clearly is this yellow line, which is the Riksbank. This is the central bank of Sweden. And you can see that they expanded their balance sheet quite substantially in response initially to the crisis in 2008. So that, by the way, this just tracks the cumulative change in central bank balance sheets over time since August of 2008. And so in Sweden, what they did is they the central bank viewed that there was significant risks surrounding the financial system there, particularly to Eastern Europe, Latvia being one main country there. And what the Riksbank did is put in place emergency liquidity facilities. The maximum or the longest such maturity facility was 12 months, most around the 3-month range. And what you can see quite clearly is they were very agile at being able to reduce the size of their balance sheet quite substantially as those risks abated. That's because they had inherent flexibility on their balance sheet. If you contrast that to what the US Federal Reserve's done, initially with QE1 buying up $1.25 trillion of mortgage-backed securities, those are very, very long-dated securities for one. Two, there's really no active market for the mortgage for MBS at this stage. So if inflation were to raise its ugly head and the Fed needed to reduce the size of its balance sheet, maybe try to shed some of these assets, I think they would find it very difficult to do so. Just in one point here, just with the ECB, the European Central Bank line here, you'll note actually it should be around the 120% level, but we didn't have data on the second LTRO facility when this chart was put together. So these emergency liquidity facilities that Sweden put in place were very similar to what the European Central Bank did as well, notwithstanding the fact that they've now come out with much longer facilities, 3 years now. But still, the ECB, in our view, has and retains a great deal more flexibility on its balance sheet than the US Federal Reserve does. You're really asking, I think, if it were to come that we did get substantial inflationary pressures in the United States, you're really asking a freight boat to move like a speedboat and turn on a dime and try to reduce the size of its balance sheet, which we just don't think that will happen. In fact, we believe that the US Fed will continue to expand. There's likelihood of a QE3. As Martin pointed out, the outlook for the economy is fairly lackluster in the United States, and in fact also that the inflation measures and expected inflation measures are well contained, so that I think that gives cover for Bernanke and the Fed to continue easing going forward. In fact, also this year and in 2013, there's a fairly dovish composition of FOMC board member, voting members, which also gives, in our view, a greater likelihood to further easing down the track, and that, in our opinion, will underpin some weakness in the US dollar going forward. The euro, obviously, a lot of talk about the euro, and today it was announced that the CDS were triggered. That should be about $3 billion worth of payments out there. Thankfully, the same board that adjudicated on that ruling essentially is made up of many of the banks that wrote those very CDS in the first place, so I'm sure they've had a lot of time to get their books in order in anticipation of such a move. I'd also point out here our outlook for Europe is fairly lackluster growth going forward, but there is a misconception out there that economic growth is a prerequisite for a strong currency. If you just look at Japan, that's a prime example. 20 years of very lousy economic growth, yet an extremely strong currency. And one of the reasons we believe the Japanese yen has performed so well is the fact that it has a current account surplus. The flip side being the US, where we have a massive current account deficit. Effectively, it means that every business day the US requires foreigners to buy around about $2 billion worth of US denominated assets just to stop the US dollar from declining. The Japanese have the opposite problem. In Europe, they have a roughly balanced current account, so they're not requiring to post economic growth to attract capital from abroad to underpin their currency. And of course, the other clear line here is the Reserve Bank of Australia, so that they actually shrank their balance sheet during this time period, and the Australian dollar has experienced significant strength, actually benefited in large part from their geographic location and commodity exports to China, given that China has continued to grow relatively strongly. One of the implications of increased policies, increased central bank intervention in financial markets is that we've witnessed increased correlation across asset classes, and so from a portfolio diversification standpoint, it's very difficult for investors now to access uncorrelated returns or add to their portfolios uncorrelated asset classes. And what we found, we did a little analysis into some of the holdings of the average US investor, and also found that there was a belief amongst many that by investing in US stocks that have significant operations abroad, you naturally get the upside benefits to foreign currency appreciation via enhancements to the foreign earnings, thereby when they're translated that should increase the overall earnings of the company and such that the overall stock price should increase proportionally to the increase in the foreign currency that the foreign earnings are denominated in. That would be the case if it weren't for the fact that US corporates are extremely active in hedging their foreign currency earnings and procurement expenses, etc. And so what we found was that US investors tend to be overly exposed to the US dollar, particularly US dollar risk. And so from a portfolio diversification standpoint, it may be very beneficial to consider adding foreign currency exposure to help diversify one's portfolio. And so in terms of practical applications, why is it that the currency asset class provides certain unique attributes? Well, in terms of the profitability, we believe that there are unique profit opportunities brought about by a large percentage of turnover within the currency space being generated by non-profit seeking entities. So not entities who are acting there as they're not trying to maximise their profits by transacting in the currency space. Who in this room has been overseas in the last 5 years? Probably everybody, almost, yeah. And have you bought a T-shirt? Have you bought a meal, paid for accommodation, etc.? Yeah. And did you purchase that meal because you thought that you could make some sort of profit opportunity by then, importing it back into the United States and selling it to somebody on the street? Probably not. So my point here is that tourism is one source of inefficiency in our minds in the currency space, as well as corporate hedges, which I mentioned earlier, generate a large proportion of overall currency market turnover. And also you have reserve managers out there and central banks who are quite heavily involved in currency transactions. Also, another misconception within the of the currency space is that it's much more risky than traditional asset classes. Well, not really. If you don't use any leverage, currency returns are actually much less volatile than the likes of the stock market. Case in point, in 2008, when the S&P 500 standard deviation of returns was up over 40%, the standard deviation of returns for the dollar index was only around 11%, so substantially lower. And following on from that, exact example, in 2008, the correlation of the dollar index to the S&P 500 was virtually zero. So from a portfolio construction standpoint, you as investors may be able to access beneficial risk-adjusted returns by adding currencies to one's portfolio. And it may help also reduce the downside deviation too. The other last point, just quickly, is that it is the largest market in the world. Currency market has about $4 trillion in daily turnover, so it dwarfs any other market out there. Spreads are extremely narrow, usually quoted in 1/1000th of a cent, so the transaction costs are typically kept to a minimum. In terms of fitting it into one's portfolio and ways to think about currencies, we get a lot of feedback in that investors consider it sometimes as a special case international bond fund, in that if a currency fund is directional in nature, meaning that it might short the US dollar to go long a basket of international currencies elsewhere, oftentimes those currency funds actually transact in the spot market, then redeploy those funds into fixed income securities, oftentimes at the very short end of the yield curve. And in that case, it can be thought of as a special case international bond fund. Similarly, it can be thought of as an alternate investment. The carry trade, for instance, momentum strategies that Sergio discussed earlier. You can really build a currency allocation or a currency fund from the ground up, such that it should be uncorrelated to any other asset class out there by offsetting long and short positions in otherwise highly correlated currencies. And what I mean by that is, if you think about taking a long position in the Australian dollar and a short position in the New Zealand dollar, two currencies that typically move in tandem, the return series that would be generated by such a pair is almost certainly going to be uncorrelated to any other asset class you might be holding in your portfolio. So with that, I'll hand it back to Barnaby.
Questions?
Yeah, so one of the most interesting of the majors, at least this year, is the yen versus dollar, and it's down to 6.5%, most of which was the February 14th BOJ announcement. So in light of a dovish central bank and the well-known fiscal challenges they have, plus institutional preference for a weaker yen, what are the risks of a crash in your mind?
Sure, and crash in the Japanese yen. I think it's a way off an absolute crash in the Japanese yen. I think the inflection point would be when Japan is relying on foreigners to fund their government deficits. Right now, it's funded domestically, so that they're not required to try to attract capital from abroad. At the point in time when they are, and that's coming down the line because of population dynamics, etc. The point in time when they are reliant on foreigners, a foreigner will look and say, wait a second. At that point in time, it's going to be debt to GDP 300% plus. And you're going to offer me, 1% for how many, 20 years? Doesn't sound like a very good deal to me. So, that's the point in time when I think there'll be significant pressure on the currency. In fact, one of the main reasons in our minds for the recent strength of the currency up until just recently has been that the Japanese haven't been influencing yields in the markets so drastically as other central banks have around the world. And you saw that with the first chart that I showed there, where they didn't really change the level of the size of their balance sheet over time. That's largely driven in our minds by the fact that they had very weak leadership structure there in Japan. They had a number of finance ministers during that period of time, and so there was little influence on the Bank of Japan to expand while other nations around the world were. And because of that, it's almost an oxymoron to say, but the yields in Japan became relatively more attractive as other yields fell towards their levels.
So the question again is what?
What's the risk of a more substantial move of the yen
To weaken.
to weaken?
So you don't think it will?
I don't think it will in the very near term. I think it's some way down the track when it will get substantially weaker. That said, I think there's a likelihood that it can weaken incrementally over the foreseeable future.
Sergio, Marty?
Well, let me just say as a general proposition, I mean, it is extraordinarily hard to predict exchange rates. I mean, it's really important to read. I'm not saying it's impossible. There's always smart guys. But Ken Rogoff, who I'm sure everyone here has heard of, first got famous with Dick Macy for showing that exchange rates are a martingale. And that's, by the way, exactly why the carry trade works on average. Because if I see an interest rate differential, what's supposed to happen is there's some predicted depreciation and appreciation that unwinds that. But that's exactly what doesn't happen systematically. Right? That's why the carry trade works. That basic theorem is wrong. So, I think we could talk about Japan a great deal, but if I personally don't feel that I can, my best bet for the yen next month is whatever the heck it is in the paper today. Now, in thinking about Japan that's why I want to exploit strategies that don't exploit my ability to predict exchange rates on a short-term basis, which is exactly the interest of momentum and the carry. Now, that one last thing about Japan. One important distinction: Japan's in terrible shape in some fundamental sense in the long run, but it is very much an under-taxed society. So even though the government debt and deficit are terrible, they do have the ability to raise taxes. At least once. So do we, by the way. Right? Relative to Europe, we're under-taxed. I'm not saying we should do that. But Japan has a long way to go before they hit some fiscal wall because they can tax their people. And they clearly have the ability in crises to do extraordinary things. They have.
Yes, please.
In your currency funds, do you use gold as a currency?
No, we don't. I mean, we looked at gold.
We have students who have looked at commodities in great detail.
And we have students that have looked at the carry trade actually for commodity markets. So the same strategies that we've shown you here work for commodity markets. They don't work as well. They are a little bit worse. And there's a lot, as you know, if you know about the commodity markets, have a lot of details, namely delivery. So you have to pull out of the contract a few days before. So I mean, those as a data issue, it's a little bit less clean because of that, because you have to worry about transactions costs. But surprisingly, the same strategies still work, but they are not as good in commodities as they are in currency markets. Now, the advantage is that, once again, they aren't correlated with anything else. So if you do the carry in commodities, it isn't correlated with the carry in currency, and it isn't correlated with the stock market. So if you wanted to build a portfolio, you could try to add a little bit of that.
One more commodity-based strategy, and that would just bring up the Sharpe ratio even more.
Yeah, those increase Sharpe ratio quite a bit.
Yeah, one of our funds, we do invest in gold as well as a variety of G10 currencies specifically.
Can we stay on gold for a few moments here? Because that's one that I think is a pretty big picture thing. Is that about gold? Nope, different? Okay, wait. So let me ask you a question. So to me, it's an obvious question is, with all the printing that's going on right now, in terms of the ECB in the U.S., what I'm looking for is tell me why we shouldn't return to a gold standard and what that would do in currencies.
Well, the gold standard was not a good idea. I mean, so usually the only people who want to live in the gold standard are those who never experienced it, because it was really very tough. I mean, we all believe that monetary policy can ease recessions, so you can lower interest rates. Under gold standard, you don't really there's not much room for monetary policy. There's a famous graph built by this historian Barry Eichenbaum that shows that the economies that did the best in the early 20th century were the ones that abandoned the gold standard first. I mean, also, if you had the gold standard in 2008, I mean, you would have had a financial meltdown because it makes governments very reluctant to be lenders of last resort. The financial system is always very liquid. They are profitable because they are very liquid, because they borrow short and lend long. When there's a run on the financial system, people have a panic and they want to get out. If there's no lender of last resort, you just melt down the financial system. And under the gold standard, that can very easily happen because governments are very, very reluctant to put the gold at risk.
There's a great book that you may have read. If you haven't, I recommend it, called The Lords of Finance, which goes through exactly the 4 key central bankers in the Great Depression and the constraints that the gold standard put on them and the ideas that go with it. If you look at there's a wonderful debate in the academic literature. The variance or the volatility of output was much higher under the gold standard than it is now. Now, if you're an academic, you say, well, there are a lot of possible reasons why that could be, right? It's not just because of monetary policy. But I think it's fair to say that there's a broad consensus in the academic literature that the actions of people like Ben Bernanke and various other people in crises have really made a difference. Now, the flip of that is, I assume that what's behind this is, should you really be worried about inflation right now? And that's the big million-dollar question, which goes back to some of the issues that we talked about. I mean, I'll let people ask pointed questions about that, but you always have to come back to the fact that the market certainly doesn't seem to be worried.
Yeah, the one thing I'd just quickly add to that is, the main reason for including gold in one of our funds is the fact that it's very difficult to manipulate the supply side of gold relative to any other fiat currency out there. Now, I'm not going to sit here and say we think that there should be a return to the gold standard by any stretch of the imagination, but from that standpoint, one of the beauties of gold, in a way, is that it reflects its inherent value very well, because the supply side cannot be quite so easily manipulated as a fiat currency.
Just add one more thing, which is you often hear that high gold prices forecast inflation. And first of all, that's based on basically one data point, which is in the 1970s. Before 1971, because of Bretton Woods, there was no gold market in the United States. And then when the gold market got liberalized, we had the 1970s where gold prices were high and this inflation was high. So we actually looked at this in great detail. Inflation is actually relatively hard to predict, and as with many other economic variables, the best way to forecast inflation in the future is to use current inflation. So if you use current inflation to predict future inflation, actually gold prices don't help you anymore. So they have no predictive power above and beyond lagged inflation in terms of predicting future inflation. So they are not a great predictor of inflation anyways, but you often hear people saying, oh, gold prices are very high, so therefore we're going to have a burst of inflation. If you control for lagged inflation, you don't have any predictive power.
I mean, I can just, go ahead, please.
I was just wondering, the Merk funds, when you had a currency convert, call it $1 to a different currency, you then back that currency with short-term sovereigns, which becomes a fixed income portfolio that you mentioned?
Right, yeah, there's two. Yeah, basically, yeah. In our flagship fund, that's how we go about investing in currencies. Basically, two basic ways, I suppose, is one to buy and take delivery in the spot market. So we would sell US dollar and buy, say, euro, and then redeploy those funds into sovereign debt, mainly. And the other way is by use of forward currency contracts. So what we would do is enter into an agreement to, let's say, buy euro a month, 2 months from today, and then because there's no initial outlay for entering into that forward currency contract, we can collateralize the notional value with the likes of T-bills, for instance.
And then once you do that, you try to go to the market and hedge the risk that was referred to earlier. And if you do, are the markets so efficient that it takes all the return out of the coupon from the bond?
Which risk, sorry?
I'm saying that if you were to hedge
expensive, it becomes prohibitive?
So we've actually done a bunch of studies on the hedging risk and looking at the prices of the puts and the calls. If you try and do this in equities, you wipe out your return, right? So we know that. So we were quite stunned. We were very proudly went off and we just assumed that these things were very priced so high that it would wipe out the return, and it actually doesn't. So that's something we simply don't understand. So the question is, who's the marginal player in those puts and calls? And it may very well be not this market. Now, I don't like saying markets aren't working efficiently, so let me just say it's a puzzle.
Sorry, yeah, we don't presently use options.
Well, there is a scenario. I mean, I was just recently at we have to get a little bit technical here for just a moment. I was at an economic advisory panel at the Chicago Fed. It turns out Charlie Evans, who's one of the dovish members of the panel, was my first PhD student, and so we have this academic advisory panel. And here's the nightmare scenario: the balance sheet of the Fed is roughly $3 trillion now, and they have about $1.2 trillion in treasuries. And then they have just a bunch in long-term mortgages. And what's going to happen is the economy starts to heat up. The way they're controlling the actions of the banks is they're just paying interest on reserves, right? So that's the so-called big base, but it's directly controllable by paying interest on reserves. And the question is, they start to pay interest on reserves as the economy has to heat up, and they're going to have to raise that rate. What's Ron Paul going to say? That is to say, will it become a point where by paying interest on reserves to the banks that the politicians are going to go absolutely nuts and prevent the Fed from being contractionary in time? And there's a way to deal with that. They've got to liquidate those long-term treasuries in time, right? So that basically they can deal with part of the problem that way. But they're still sitting on a bunch of long-term mortgages the other side of the balance sheet, right? So there's still going to be a lot of reserves that the banks are sitting on that they have to be paid for. That's a very bad scenario. So if I thought we were entering into that scenario, where the politician would say, so here's my scenario. So I'm sitting here, and there's a banker over there and saying, let me get this straight. You, Ben Bernanke, are raising interest rates to cool down the economy by basically taking the tax money of the American citizen and giving it to the Wall Street banks. So that's going to be enormous political pressure to prevent the Fed from cooling down the economy exactly when it has to. That's the one scenario that's extremely dangerous. But as I say, bond markets don't seem to be putting a lot of weight on that scenario. I actually personally put more weight on that scenario than bond markets seem to be.
Yeah, if I can just quickly add to that, the banking industry is highly competitive in the United States, and it's not out of the realm of possibility that those reserves sitting on the balance sheet basically flow straight back into the economy very, very rapidly. If you think, say, a Citibank sees JP Morgan drawing down those reserves to lend out because they feel that the economic outlook is much, much more improved, then they're going to turn around and draw down those reserves themselves. And so that money can be drawn off of the balance sheet very, very rapidly. We just question that the Fed is able to counteract that rapid drawdown.
Let me just say, technically, what the Fed can do in that situation, the minute it thinks that situation is right, it can just raise rates. It'll just pay them more. So that there's simply no incentive for the banks are happy making 5% if it's coming from the Fed. The constraint on that, and they can do that, there's just no constraint on their ability to do that other than the political process, which is a very real constraint.
Yeah, no, completely agree with you about the political aspect.
I'm sorry, somebody's not making sense. So if you've got these, right now they're going into long-term bonds, right? They're taking into the Operation Twist, they're converting into longer-term treasuries.
Yes.
That's an asset on their balance sheet. Now, if they raise rates, isn't that going to cause the value of those bonds to go down?
Sure, but so what? They can wait it out. The one advantage the Fed has over anybody else is they have an infinite horizon. They don't have to sell the bonds.
You can hold the bonds to maturity.
They'll hold the bonds to maturity.
But if they have inflation greater than their, those are going to be worth way less. The money.
Well, no, but by raising the theory behind it, which one can disagree with, is precisely by raising rates, they're going to slow down the economy, so that inflation isn't going to be very high. So, I mean, it's a coherent view that the Fed has.
But they don't mark the market, right?
No, they just wait.
That's the essence of your
Yeah,
point, right?
sure.
They don't have to.
Exactly.
going back to your inflation and things you look for, one of you made the comment that it takes $2 billion a day for our friends in the world to show up to keep keep the engine running. So what would you look for to suggest there was a change in the willingness of the rest of the world to spend the $2 billion a day to keep our lifestyle afloat, such as it is?
Well, I think if you saw a significant uptick in Treasury yields, for now the US government has basically been given a pass to really not implement any form of sustainable fiscal change. If you compare and contrast that to what's happened in Europe, the bond market there has forced upon the different nations fiscal austerity measures. It just hasn't happened in the United States, and that's why I think policymakers in Washington have sat on their laurels to a certain degree and not really implemented any substantial change yet. But at the margin, I would say we have witnessed certain weakness in the US dollar over time.
Don't you think that they're really just recapitalizing the banks right now? And that's why maybe, like, one of the things you're calling anomalies or non-market, things that aren't fitting into your normal market is because it's not really a normal market.
But remember that this is data going back to the 70s. So the anomalies that I was showing you, these are long. Yeah. So I mean, I don't think.
Yeah, there's a footnote, and we went by a little too quickly, but these models were fit. I think the initial sample period was 76, and going through the current crisis.
Two questions. One, you point out the TIPS market seems to forecast low inflation. But back like in 1982, when the long bond was 14 or 15%, presumably the market was forecasting or assuming pretty high inflation that we had in the past. So how do you know when you can rely upon Mr. Market's assessment and when not to? And then before I forget, when someone does a naked short on a currency, like Soros shorting the British pound when he did engage or whatever, on what basis is someone like that making that sort of judgment? What sort of analysis are they doing to say on a naked basis that currency is overvalued?
I mean, there was a very special episode in which, remember, it was on the transition to the euro system. This is 1992, I think you're talking about. And as a transition, in the transition to the euro system, Europe adopted a system of basically fixed exchange rates. So even though there was not a single currency, but everybody was basically fixed to the Deutschmark. That's how it worked. And England was in a recession. Now, if you are in fixed exchange rates, you have no monetary policy, right? Basically, if everybody's pegged to Germany, Germany is driving monetary policy for all of Europe. Germany was in an expansion, but the UK was in a recession. So Germany was raising rates. To keep the exchange rates fixed, everybody else had to raise rates. And the UK was doing worse and worse. So the Soros bet was a bet about if you put pressure on the central bank, they would blink because they didn't want to continue. The way you defend against the speculative attack on fixed exchange rates, when people are shorting your currency, you have to raise rates even more. Sometimes banks raised it, the Bank of Sweden raised it to 300%, for a few days to try to scare the speculators. Because remember, you borrow pounds that you don't have, and you sell them. So how do you stop speculators? You have to raise interest rates, so it's really expensive to borrow the pound. So Soros was saying they are already bleeding. If I take a big bet, there's no way they're going to raise the interest rate to sort of deter speculators, and he made a lot of publicity that he had made this bet. So there's a lot of herding in these markets. So once you hear that a big player is doing that, a lot of other players start doing the same thing, and it can be self-fulfilling. That's the problem with fixed exchange rate systems, that this can really quickly become self-fulfilling. So he made $1 billion in one afternoon. That was pretty good. I mean, later on he lost $2 billion in Russia though in '98. So.
On the issue of markets being right, I want to emphasize, I don't think markets are always right. That's not my position. But what I do want to just emphasize is the kind of people right now that are running around saying inflation is coming, are the ones who often say markets are fantastic and are always right. And there's an inconsistency in that position. You can take the position markets are wrong this time, and I personally would attribute a higher probability to inflation than I think I see in bond markets. That's okay. But then you got to say, I disagree with the market.
What about currency wars?
Currency wars. Well, okay, so I'm actually doing some work now. Right now, there's a big literature on when fiscal policy has a particular punch. And it's called the zero lower bound literature. And that literature says that when interest rates are stuck at zero, if you have a big fiscal expansion, you're not pushing up interest rates and crowding out consumption investment, so fiscal policy is particularly powerful under those circumstances. The connection to your question is, the same logic tells you that a currency devaluation is particularly powerful then, because it's not like you have to pay taxes on it. It's a pure boost to demand, exactly in a situation when that's incredibly valuable. So the incentives to devalue competitively your currency are incredibly large now for every country. The problem is not everybody can do it simultaneously. We can't all devalue our currency. That's unfortunately the math. So everyone has an incentive, taking the other guy's actions as given, to try and devalue their currency. But we can't all do that simultaneously. Exchange rates are exchange rates.
That's the exact problem that Brazil is facing right now. They feel that the appreciation in their currency has been largely brought about by the monetary policies in the United States and in Europe particularly. In the currency space, a currency always trades against another. So if one currency appreciates, that means by definition another currency has to go down. And with the Brazilian real appreciating, it's against the US dollar particularly. And it's experienced pretty substantial appreciation this year. The feeling in Brazil is that that's really hampering economic growth in Brazil particularly. I think forecast is now only around just over 2% for 2012. So, that's largely where we're seeing voices coming about currency wars these days.
Can you comment on the euro, despite being used at least temporarily? It looks like we push things out a little bit.
Yeah, I think.
Greece
Yeah,
having to withdraw in some.
Right. Yeah, I mean, we're certainly not at the end of this drama that's unfolding. The next big thing, obviously, in Greece will be the elections. Who knows how that will pan out, whether or not the new government will actually implement all the promised austerity measures. And that's going to only increase the lack of clarity that we're seeing in the markets. In Spain, they just recently announced that they've reduced their budget deficit target, and then in Portugal, expectations are for much worse unemployment and GDP growth as well. Also, there'll be talks, I believe, the end of this month regarding increases to the financial firewalls there, the ESM and the FSF, on the back of the G20 basically telling Europe, hey, if you guys don't increase those firewalls, then we're not going to provide you with any more money to help protect any further fallout there. The currency, turning to the currency specifically, I think near term there had been a large build-up in short positions. A lot of those may be unwound, so there could be some natural upward pressure on the currency there. As I said before, there continues to be a lot of concern around Europe. The outlook is very lackluster for economic growth. That doesn't necessarily mean that you can have that you'll have a weak currency. In fact, relative to the United States dollar, I think the euro can hold up relatively well, simply because the ECB seems to be less expansionary in their policies than the Fed is likely to be this year.
I'm not sure about that. But a quick comment on the euro and on exiting the euro. So I'll be on safer ground. So one question that people are asking in Europe is the strength of the euro, how much of it is related to the fact that a lot of banks are selling operations they have overseas in anticipation of losses at home. So they want to protect themselves. So you've seen a lot of inflows into Europe as they sell these operations that has perhaps helped prop up the euro in the short run. The other comment is on how easy it is to exit the euro, and it relates to this famous Soros episode we were talking about, because that was very traumatic for Europe. Speculation had led some countries to abandon the European monetary system, as it was called at the time. And for a long time, it looked like the euro project was not going to happen. And so because of that, when the euro came into being, the payment system in Europe was redesigned, and there was this system called Target. So the national payment systems were eliminated, and there's this Target system that's Europe-wide. And because of the Soros incident, they didn't leave an exit button. So it's extremely difficult to exit Europe because you have no payment system. So the mechanics of doing it are quite complicated, very difficult to avoid bank runs or run on the financial system, and a certain amount of chaos. So it's quite costly, I think, to leave the euro. It's not an easy proposition.
Any comment on your interpretation of the run-up in gold prices and outlook for the
Gold prices.
Yeah.
Sure.
Kieran?
Our take is largely driven by it's a safe haven play. For the most part, we've had unprecedented levels of policy intervention. A lot of actually asset prices are no longer really trading on fundamentals these days. They're trading more on anticipation of next policy makers' moves. The crisis in Europe has really, I think, basically underpin some I guess, pessimism over whether or not policymakers can actually come together and put meaningful measures in place such that the long-term sustainability of that zone in particular, and for that matter, even turning to the US, that Washington can even come together, reach across the aisle and actually come to some substantive, I guess, decisions on how to tackle the long-term fiscal situation that seems to be a wreck. But I think with the increased volatility in the markets, a lot of money has flown to safe haven asset classes such as gold. That's traditionally built.
But you're saying that, but you guys have said that gold limits your ability to respond to crisis.
If you're on the gold standard.
If you're on the gold standard. If you're on the gold standard.
So why, and yet you have this flight to the fear trade and people wanting to accumulate gold. So you have China now accumulating gold. Why would they be doing that?
Oh, I think China just wants to diversify its portfolio of reserves. I mean, right to now.
So but what's the purpose of gold then? If it doesn't stabilize a currency, if it doesn't as a reserve currency.
It's just an asset that has
It's
a
just
rate of
another
return
asset.
that's uncorrelated with other assets.
Yeah, I don't think they're accumulating gold so as to go on some gold standard. It's just they can hold this, quadrillion dollar of reserves, in peanuts and in dollars and in euros and in gold. Why not? It's just another diversification.
And on that point, in fact, that the amount of gold that they've diversified into and accumulated proportionally is much less so than some of the other currencies that they've diversified to in absolute terms.
The strengthening of the Australian dollar has made their exports, particularly to us, who are pretty good-sized trading partners, a lot more expensive. Are they really worried about that at this point? I don't hear much about what.
Well, Australia is a commodity country, so if you look at commodity countries like Canada or Brazil or Australia, the strength of their currency really moves very closely with commodity prices. And so it's a little bit, it's true that if you are a manufacturer in Australia, that's not going to be an easy ride. If you're a commodity producer, it's true the currency is expensive, but commodity prices are very high.
It's a mixed blessing.
It's a mixed
right?
blessing.
Silicon Valley is doing really well. Houses are expensive, right? If the world commodity price, there's demand for commodities. Australian.
The Reserve Bank of Australia actually.
I thought I had skirted that.
Don't let you go.
I'm a big subscriber to the contagion theory, and I don't think it's contained. So, the Spanish banks have about 60, 70 billion of Portuguese debt. So Portugal, although smaller than Greece, if that, and their short rates now, 13, 14%. I mean, at what point will the market tell you that it's unsustainable?
Well, I would say let me try to say as little as possible, but I would say the rates in the secondary market are not very important because basically there is no market for Portuguese debt right now. So whether the rate is 16 or 20, I mean, that's not a very liquid market.
Spain trying to settle their position in an illiquid market?
I mean, there's not a lot of trade. There's not a lot of trade in that market. What's certainly, I think, almost certainly true is the initial program, the so-called Troika program, forecasted that Portugal would have access to markets in 2013, and I don't think anyone believes that at this point. So Portugal's strategy is to be the good student. You know, Greece was a student that didn't do very well on the exam, and then Portugal is studying really hard and hoping that it's going to be the good student, and then
the teacher's German, and we'll reward Portugal.
Right, and the European Union will say, well, we need they studied hard, so let's give them a little bit better conditions. And I think that's the strategy of the country right now, is to do some hard things and then hope for better conditions down the line. But I think the expectation is that Portugal won't return to the market certainly in 2013. Iceland? I think very low, because typically it's not a good idea to adopt a currency from another country, because then you don't have monetary policy. And you could see like a great example of that in Argentina. In Argentina in 1998, they were in a recession. They were pegged to the US dollar. And it seems to be kind of cute that they call the U.S. and says, well, we are this country on the south, and we would like you to see if you could lower rates or something. But, of course, the U.S. was on a big expansion, so it was raising interest rates. So interest rates had to go up in Argentina to maintain the currency fixed. So in general, you want the flexibility of having your own currency, and what you see in Europe, the problems that you see in Europe are really a reflection of the fact that all of these countries gave up their currencies, and essentially they all have the Deutsche Mark. If Portugal had its own currency, it would be in so much better shape right now. I mean, it doesn't resolve everything, and it also to some extent prevents one of the big problems in Europe, is that there was this tremendous amounts of credit that flowed from the north to the south. And that's because there was no inflation risk, and the perceived risk of default was quite low. When you have your own currency, you cannot hide that risk. So before the euro, consumer credit was much more expensive. So it was not uncommon for kids to borrow from the parents because interest rates were high, because they had a big inflation premium, because the south of Europe did not contain inflation. Now you become part of the euro, everybody believes it's a marriage that's going to last forever, and this risk disappears. Interest rates are very low, borrowing is very cheap, and you create this bubble from borrowing from the north of Europe. So it's also not a great idea to, so fixed exchange rate regimes usually create these booms and busts episodes, that credit flows in, you have a boom in housing markets, you have a period where the economy grows at 7%, then you have a boom in equity markets, all this money flows in, and then it all comes to a sorry end. So in general, it doesn't seem like a great idea.
To pick up on that, study after study after study that asked, was the euro a good idea from a strictly economic perspective? The answer was no. We kind of know Bob Mundell got a Nobel Prize for asking, when should two regions form a common currency? Because we obviously don't think that side of the street should have a different exchange rate or currency than this side of the street. So Mundell said, look, one good thing is if labor markets are very flexible. So if a bad shock hits my side of the street, I can go across the street for another job. Or if there's fiscal transfers between the two sides of the street, that's a good thing too, so that if I have a recession in my street, somehow there's an automatic way for fiscal transfers to go to the other side of the street. And that's really, and also of course that the shocks hitting the two sides of the streets are very similar, so monetary policy would want to respond in the same way. Now, the U.S., it's true that we have a lot of different kinds of shocks in different regions, like in Europe, but what are the big differences between us and Europe? Labor markets are much, much more flexible, partly because of culture, language, etc. Right? Southern Italy doesn't want to move to Northern Italy, right? But you can move from New York to California, and the Walgreens looks pretty much like Walgreens. Finally, there are automatic fiscal transfers because of the U.S. federal tax system. We don't have to think about them. If California goes through a recession, your taxes goes down. And if New York is going through a boom, their taxes go up. There is no mechanism like that in Europe to deal with those shocks when they do happen. So you can easily argue that the U.S. is an optimal fiscal union, but that Europe is not. Why did they do it? Well, it's called World War II in France and Germany. Right? They have a political grand bargain that they entered into. We could talk about the politics of that. So it was clearly very much a political idea, not an economic one, in terms of the rationale.
So what's your long-term view? I mean, do you think that the euro goes away?
I think there's enormous pressures on it. To me, it doesn't make any sense. I think if they could figure out a way to get out of it, they would. Basically let the South secede. But it's the transition problems that Sergio talked about are extremely difficult.
So the market's view is that it's going to be very tough to sustain. Again, the difficulties of leaving the euro are enormous. And actually, the best way, if you want to dismantle the eurozone, would be for Germany to leave. Because Germany could pay its debt in euros, then the Deutschmark would appreciate, of course. They would look like Switzerland. But there will be no defaults. And then the rest of Europe would have the euro, and they could have a weaker euro. They could follow more expansionary monetary policy. But because of World War II, that scenario is not likely to happen, that Germany doesn't want to be seen as leaving the Eurozone. If you talk to Europeans, they have a very different perspective. Their perspective is every time there's been a difficulty in Europe, there's been tough times, but then the response has been more integration. And they point to this Soros event as an example, which is in 1992, everybody thought the unification of currency was a dead project. And in fact, what they did is they moved faster, and the euro did happen. So we will see whether there will continue or not, whether in fact a response to difficulties is more integration. I think one issue that has to give people some pause is that we have a new generation of politicians who didn't live through World War II, and they are more nationalistic, they are more looking at their own economies, and they are less Eurocentric, they are less committed on the building of the United States of Europe.
I would just add to that, it's absolutely striking to me as both of us visit the ECB and have friends, etc. Things are now said in the ECB that were unthinkable 10 years ago, sort of nationalistic-based statements, jokes about one, I won't even say what
he thought.
It's irrelevant. But you see these tensions. When you double down the bets on integration, you're doubling down the bets. So the divorce could be that much more ugly. So I'm quite stunned to hear the kind of things I'm hearing now about German intransigence, Greek lazy. Those are things that were unthinkable 10 years ago, 5 years ago. So there's real tensions. But the cost of this divorce is really high.
So the euro's here to stay.
That would be my bet.
And there's no inflation problem. And it would be bad to go to a gold standard. And Japan's in great shape.
No,
not
let me give it. German, look, the euro's not going to...
Don't move to Japan.
Let me be clear. So what I think is Japan is in terrible shape in terms of per capita growth in the long run. I just don't see it as exploding. You can have low growth, but not a crisis. Europe can, trudge along at incredibly low growth rates for a really long time and just not grow very fast. So I want to distinguish between crisis and just life sucks generally. Those are very different scenarios.
Well, I could go on for a long time. Wait, we're supposed to stop at what time? 5 minutes ago? Okay, so I have one note. When you go back over to Arriaga, you need to re-register when you walk in, okay? Thank you very much.